You got the raise. 3%, maybe 5%. Your manager smiled when she said it. HR sent the updated offer letter. You felt for a moment like the system was working the way it was supposed to. Then the rent renewal arrived. Then the grocery bill. Then the health insurance premium update for the new year. And somewhere between the congratulations and the new direct deposit amount, something quietly didn't add up. You earned more. You have less. And nobody in the room where they told you about your raise mentioned that part. This is not a personal failure. This is not a budgeting problem. This is a specific structural feature of the 2026 economy that is erasing the gains of millions of American workers in real time while they celebrate the very number that's making them poorer. Start with the raise itself. The average salary increase in the United States in 2026 is sitting around 3 to 4% for workers who receive one at all. That sounds reasonable until you place it next to the actual cost of living increases that the same workers are absorbing simultaneously. Shelter costs, rent and mortgage payments are up between 6 and 9% in most major metro areas compared to the previous year. Grocery prices have compounded more than 30% since 2020 and continue rising at rates above the headline inflation figure. Healthcare premiums for employer-sponsored plans increased an average of 7% entering 2026. So the math, when you actually run it, looks something like this. You received a 4% raise on your salary. The things you cannot stop buying, housing, food, healthcare, went up between 6 and 9%. The raise did not cover the gap. The raise made the gap look smaller without closing it. And you are now working harder, earning nominally more, and falling further behind in purchasing power than you were the year before. This is not an edge case. This is the median American worker's experience in 2026. But the raise doesn't just fail to keep up. In several specific situations, it actively triggers new costs that make the net outcome worse. The first is tax bracket creep. The United States tax system is progressive. Higher income is taxed at higher rates. Brackets are supposed to adjust for inflation annually, but the adjustments consistently lag behind real inflation, which means a raise that does nothing but keep pace with rising prices can nudge a worker into a higher marginal bracket. The worker pays more in federal and state income tax on dollars that in real terms buy no more than last year's dollars did. Their nominal income went up. Their real after-tax purchasing power went down. The government quietly captured part of a raise that was never genuinely a raise to begin with. The second trigger is benefits cliff erosion, and this one is particularly brutal for workers in the $35,000 to $75,000 income range. Several government assistance programs, housing vouchers, child care subsidies, healthcare cost-sharing reductions, food assistance, use income thresholds to determine eligibility. A modest raise can push a household over a threshold and eliminate benefits worth several times the value of the raise itself. A family receiving a child care subsidy worth $400 a month loses it entirely when income crosses a certain line. The raise that caused the crossing might be worth $80 a month in take-home pay. Net change, negative $320 per month. They got a raise. They announced it to their family. They lost ground. This is not a hypothetical scenario. Benefits cliff calculations are a documented, studied, widely acknowledged feature of the American social support architecture, and they remain largely unaddressed because fixing them is expensive and the people most affected by them don't have lobbyists. The third mechanism is the subtlest and possibly the most corrosive. A raise changes behavior. Behavioral economists have documented what happens when income increases modestly, even when the increase doesn't meaningfully improve purchasing power. People adjust their self-perception. They feel slightly more financially secure. They absorb slightly more risk. They are slightly more likely to take on a new subscription, a slightly better car payment, a slightly larger credit card balance. This is not irresponsibility. It is human psychology responding rationally to a signal. The signal being that income went up. The problem is that in 2026, that signal is lying. The raise is a nominal increase attached to a real decrease, but the brain processes the number, not the purchasing power behind it. And the modest behavioral adjustments that follow, each individually reasonable, compound into a financial position that is structurally weaker than before the raise arrived. You feel more secure. You are less secure. And the gap between those two realities is where financial vulnerability quietly builds. Zoom out, and the picture becomes even more uncomfortable. The companies delivering these raises are, in many cases, reporting strong earnings. Profit margins in several major sectors remain at historically elevated levels in 2026. Executive compensation continues to grow at multiples of the workforce raise rate. The 3 to 4% offered to the median worker is not a reflection of what the company cannot afford. In many documented cases, it is a reflection reflection of what the company has calculated it needs to offer to retain the worker, which is different. The raise is sized to your replacement cost, not your contribution value. And your replacement cost in an economy with AI tools compressing the market rate for knowledge work is lower than it has ever been. You received what the market required them to give you, which in 2026 happens to be less than what staying in place actually costs. So here is the thought that lingers after the congratulations fade and the new paycheck arrives and the math still doesn't work. What does it mean to get ahead in an economy where the definition of ahead keeps moving faster than your raise? And more quietly, if the people setting your salary know the raise won't keep up, and the people setting your rent know the raise won't keep up, and the system producing these outcomes keeps producing them year after year, at what point does getting a raise stop feeling like progress and start feeling like something else entirely? If this number hit differently than you expected, share it with someone who just got their raise and hasn't run the math yet. And if you want to understand the full picture of where this economy is taking the people living inside it, the next video is already waiting.